Welcome to your custom deep dive. We've processed your sources on the economy for the week of October 6th through the 13th. Our goal today, simple. We're breaking down why market volatility suddenly came roaring back and why tariffs are dominating the headlines again. This is really your fast track to getting up to speed.
Exactly.
Okay, let's unpack that, because before the big market shock on Friday, we actually need to talk about the consumer, right? There was a kind of surprising health check. Economic data was pretty light because of the shutdown, obviously, but the University of Michigan Consumer Sentiment Survey did come out.
Yeah.
Landed at 55%.
Yeah, and on the surface, that number, 55%, it looked okay. Stable, maybe slightly above what people expected, basically flat from the month before. But, when you connect this to the bigger picture, it's actually, it's a very unsettling data point.
Unsettling. How so? I mean, 55% doesn't immediately scream crisis, does it?
No, not until you look back. It tells you consumers are feeling incredibly pessimistic right now. I mean, think about it. 55% is dramatically low. Pre-COVID, February 2020, that number was 101%. And here's the real kicker, the fact that should really stop you in your tracks. That 55%, it's actually lower than the 55.3% recorded during the absolute worst part of the Great Financial Crisis, November 2008.
Wow. Okay, so sentiment right now is officially worse than it was during the depths of the housing collapse 15 years ago.
Yeah.
Sobering. But our sources did note that consumers aren't freaking out about the shutdown yet. Their main worries are still jobs and inflation.
That's the key context, exactly. The shutdown, now 13 days long after, 6 failed votes, hasn't really hit spending directly, but the lack of official economic releases because of it, that's already cranking up the uncertainty level. Not just for markets, but specifically for the Fed members. They're flying blind on some key data now.
Right. That lack of clarity must be a real headache for the Fed. And speaking of the Fed, those FOMC minutes that came out, they show the committee is already having serious trouble agreeing on things, which leads us straight into this idea of divided minds on monetary policy.
Yeah, the initial vote back in September, the one to cut rates by 25 basis points, it looked unified 11-1, but the minutes, they pull back the curtain and reveal this deep, significant lack of consensus among the 19 members. It's quite striking.
Our sources really hammered this point. Stephen Stanley over at Santander U.S. Capital Markets, he put it pretty bluntly, didn't he? He noted significant differences of opinion within the committee regarding just about everything important. That sounds serious.
It is. And specifically, you've got 7 out of the 19 Fed members who want absolutely no more cuts this year. None. They either think conditions are fine as is, or they're worried about reigniting inflation. For them, the cutting cycle is done.
Okay, wait a minute. Hold on. How does that square with the market? Investors are pricing in, a 96% chance of 50 basis points total in cuts by year end? How can the market be that sure when almost half the committee is basically saying no more? Are investors just calling the Fed's bluff?
It really looks like a confidence trade, doesn't it? The market seems to believe that, look, whatever the internal squabbles are, the Fed will ultimately have to bend to market expectations, to prevent a sharp slowdown. And investor conviction actually increased over the week. That probability jumped from 83% up to 96% for those 50 basis points. The market expects them to find a way to cut, even if the members themselves aren't there yet.
Right, which brings us neatly to Friday. The moment reality, or maybe just renewed fear, collided hard with that confidence. The return of market volatility. It felt like it came out of nowhere and hit like a punch to the gut.
Oh, volatility is definitely back. And Friday was brutal. U.S. stocks dropped 2.7%. That's the biggest single-day fall we've seen since early April, wasn't it? The last time we had those major tariff-related sell-offs.
And the VIX, the fear gauge,
jumped straight above 20. That's its highest level in nearly 4 months. Real sign of nerves fraying.
So what exactly set it off? What was the specific trigger for that sudden panic?
It was those renewed trade hostilities. U.S. and China back at it again. Beijing put restrictions on exporting rare earth mineral stuff, absolutely crucial for tech manufacturing.
Yeah.
And President Trump immediately fired back, threatening massive tariffs on a whole range of Chinese goods.
Okay, classic game of chicken. But then Monday happened. The market clawed back over half of Friday's losses almost immediately. That seems like a rapid mood swing. What caused that?
Well, it seems to boil down to essentially a single calming social media post from the president, basically saying, and I'm quoting here, "Don't worry about China. It will all be fine. Highly respected President Xi just had a bad moment." That acted like a sort of psychological circuit breaker, just gave the market enough reassurance for a quick bounce.
A quick bounce. Okay, but the underlying problem, that fundamental tension, it's still there, isn't it? Unresolved. So what's the real long-term worry about this trade dispute flaring up again?
Look, The dispute is serious precisely because of this core assumption being made on both sides, in Washington and Beijing. Each side seems to be operating as if the other has to back down first. And that premise, that creates a super volatile situation. Any misstep, any miscommunication, a diplomatic slip-up, a misinterpreted tweet could dramatically escalate things. Massive economic miscalculation is the real risk globally.
It felt very much like a U.S.-centric drama on Friday, but zooming out, this wasn't just contained to the U.S. market, was it? The pain was broader.
Not at all, no. World stock markets generally sold off even more than the U.S. did. If you look at the weekly numbers leading into Monday the 13th, developed market stocks down 2.1%. Emerging market stocks fell 1.9%. So yeah, broader pain.
But there was one notable exception, right? One major market actually managed a small gain.
Japan, yeah. Up just 0.3%, but still up.
What was the story there? What gave Japan that bit of resilience?
It seems to be the positive market reaction to the election of Takaichi Sane. She's the new leader of Japan's ruling Liberal Democratic Party, and she's now potentially poised to become the country's first female prime minister, which is historically significant, of course.
And what's her expected policy direction? How might that play into this whole global trade picture, especially with the U.S.-China tension back?
Well, The Economist suggests she's likely to pivot Japan back towards a, quote, more muscular version of the economic policies that her mentor, the late Abe Shinzo, introduced.
Okay, let's circle back home then to the damage report here in the U.S., moving into our third section. We know some individual stocks hit highs earlier in the week, but that Friday sell-off really dragged the overall weekly performance down by Monday the 13th.
Yeah, the damage was pretty widespread by the end of the week. Large caps down 1.3%, small caps fell 1.0%. Growth stocks held up slightly better, down 0.8%. But the real story, interestingly, was value stocks. They took the biggest hit, down 1.8% for the week.
This week also kicks off earnings season in earnest. The big banks are front and center. We've got JP Morgan, Goldman, Wells Fargo, Citi reporting Tuesday, then Bank of America, Morgan Stanley, PNC on Wednesday. Expectations seem pretty positive, but there's a bigger question investors are asking, isn't there? Something beyond just bank profits.
Oh, absolutely. This is what some are calling the AI imperative test. Look, for the past year or so, billions, multi-billions have been poured into AI capital expenditures. That spending has driven huge stock gains, sure, but mostly in semiconductor and hardware companies. You know, the guys selling the picks and shovels for the AI gold rush.
Right. Everyone knows the chip makers are booming.
Exactly. But now investors need to see that massive investment translating into actual positive bottom line impacts outside of the chip sector. We need to hear from software companies, retailers, manufacturers. How has AI actually lowered their costs, opened up new revenue streams? If these other sectors don't start showing a clear return on investment from all that AI spending soon, those really high valuations supporting the whole market could deflate pretty quickly.
A key test indeed. And while the market was getting nervous about tariffs and trade, we saw that classic flight to safety. Money poured into, well, gold.
Gold did exactly what you'd expect it to do in this environment. It hit a record high, past $4,000 an ounce for the first time, ended the week up 3.8%. And just look at its performance on Friday alone. Gold was up over 1% while stocks were tanking over 2%. Then it kept climbing on Monday, up another 2.3%, even as stocks tried to recover. Classic defensive move.
That's undeniable strength. Really confirms its safe haven status is intact, especially when geopolitics get messy.
Definitely intact. However, we do need to talk about the cost of that safety now. Gold is becoming a very expensive hedge. When you're buying gold at these levels, over $4,000, you're paying a massive premium for protection before a potential crisis really hits hard.
So what's the downside of paying that premium? What's the consequence?
Well, the main consequence is that its potential upside during the next true market crisis might be severely limited. Think about it. If you bought gold at $1,800, a major crisis might push it towards $2,500, maybe $3,000. A nice gain. But if you're buying now, near the highs at $4,000, how much higher can it realistically go in a panic? You risk owning something that holds its value, yes, but maybe doesn't give you those significant gains you need precisely when everything else is falling apart. It limits your options.
Makes sense. An expensive insurance policy. Okay, let's wrap up the data points with fixed income. Bonds. Even with the shutdown adding uncertainty, bonds rallied pretty hard through last Friday, right?
They did. The fixed income markets were closed Monday for the holiday, but that move on Friday was really quite remarkable. The 10-year Treasury yield fell 9.7 basis points just on Friday, right when that U.S.-China trade news hit.
9.7 basis points. That sounds significant, but maybe help put that in perspective for us. How big a move is that for one day?
It's a very large move. For context, a typical one standard deviation move for the 10-year yield in a single day is closer to 6.5 basis points. That's an exceptionally violent rally into safety. It shows the sheer level of fear that flooded into treasuries during that tariff panic. For the whole week, the 10-year yield fell 11.1 basis points, closing Friday at 4.05%.
Okay, so let's try and synthesize all this. Looking back at the economic news from the week ending October 13th, we're seeing this dual tension everywhere, aren't we?
Absolutely. That's the core theme. You've got a policy landscape just riddled with division, whether it's the Fed's internal split or the divided government causing the shutdown in Washington. And then you have a market landscape defined by renewed fragility. You see it in the extreme sensitivity to trade shocks, and you see it in the really high premium people are paying for safe havens like gold, even at inflated prices.